All right. So we are looking at the question 4. Question 4. Now it says that the following are the financial position of Robbie, Hale, and Zinc, all public limited companies, as at 31st May 2013. You have your assets. Look at it very carefully. Very carefully. Okay. Properties are there, investments are there. The investment, they have names attached to it, Hale and Zinc, so watch out. Financial assets is there, joint operation. Joint operation is not something you are supposed to recognize as an asset. So you will see what will happen to it. Current asset, total asset, equity and life, ordinary, other component equity, all these things are there. So as usual, your approach to solving a console P&L or balance sheet is to look at the requirements first. So if you check the requirement, you are supposed to prepare a consolidated statement of financial position, and that is exactly what you start. So you say Robbie Group. Statements of consolidated statement, sorry. Consolidated statements of financial position as at 31 May 20x3. All right. So you just redraft the financial statement, the balance sheet. So, of course, it's a million. You know that goodwill will come via workings 3. Then you also have property, plants, and equipment. Then you have the investment. Of course, there are names attached to it, so everything is meant to vanish. You have financial assets. You have joint operation there. You leave 2 spaces, anything can happen, like I always say. You have your current assets all together. So you will have your total assets. Okay. Equity and liabilities. You have your stated capital. So you will read a question. If there is no share for share exchange, that's the first one you are supposed to do. You also have OCE. You have retained earnings, which will come via workings number 5. Leave a space and put your NCI, which will come by workings number 4. Then you go to your liabilities. You have your NCL, which is together. You also have your CL. So you set your things up, set it down. All right. Now you read the question, then you see what is in it for you. All right. So it says the following information is also relevant. On June next 1, Robbie acquired 80% of the equity interest of Hale. The purchase consideration was 50. Now, anytime you are reading a question, always check here. It's 55 here. Now it is 50 here. So it means there is something that has happened. Always be monitoring those things. Robbie has treated the investment in Hale as fair value through OCI. You see, so it means that he has done 80% too, but he has treated the investment as fair value through OCI, meaning that any change between what is here and what is in the balance sheet here is a revaluation surplus that they have recorded at their OCI. And because this is a consolidation, you will have to affect it. So your purchase consideration is 50, meaning that the 5 is a revaluation gain through OCI, which you need to go and cancel. All right, so take note of that. So I should have even done the investment. So yeah, so let me do the investments. If there is even space, yeah, let me do the investment. So these are certain things you must know. I think, all right, I'll talk about it. I will know what to do. It has erased now. So investment, you have hail, you have zinc. It's not supposed to be there in your balance sheet like that, but I'm using it to show you something. All right, it's usually not supposed to be there like that, but there is a revaluation that has happened. And you see there it is 55. This one too is 19. All right, then I had financial assets. I have joint operation. But you can decide not to bring it there and do it somewhere else. All right. Because at the end of the day, since the name was attached to it, they must vanish from your books. All right. So that is that. A dividend received from Hale on 1st January 20X3, 2 million has similarly been credited to OCI. Dividends shouldn't even go to OCI in the first place. It's between, if you receive a dividend, it's an income for you, and it also increases your cash. They didn't talk about the cash side. They have said that they have recorded the credit to OCI. The debit is cash, but they didn't talk about that. So the credit to OCI is also a wrong thing. It's supposed to be in the retained earnings. Then also understand that intra-company dividends are cancelled. I hope you know that. You can't be paying yourself dividends. All right. So in Robbie policy is to measure NCI at fair value 15 on 1st June when they bought the company. On June X1, the fair value of the identifiable net asset was 60 and the retained earnings was 16. Excess of fair value net asset is due to increase in non-depreciable land. All right. B. On June XO, Robbie acquired 5% of the ordinary shares of zinc. Robbie had treated this investment as fair value through SPL. Okay. So it means any gain is done in the SPL. That's the meaning. In 20X2 May. On 1st December 20X2, Robbie acquired a further 55% of ordinary shares of zinc and gained control. So this is a step acquisition. So you should know how you do your purchase consideration. So this is what they have done for you. So that is that. So 5% was acquired at 2 million. 55 was acquired at 16 million. Together you have 18. So this one too, go to the balance sheet and see the 18 should reflect there, but you have 19, meaning that there has also been a revaluation. And that also means that that revaluation was done through SPL. That's what you were told. All right. Okay, so, and the revaluation should be cancelled away because it can't be there. You are one company. Okay. Then it says at December, the fair value of the equity interest in zinc held by Robbie before the combination was 5. So fair value of previously held interest. That is it. It is Robbie's policy to measure NCI using fair value, and this was 9. Okay. The fair value of identifiable net assets at 1st December 20X2 for zinc was 26 million, retained earnings 15 million. The excess of net assets is due to increase in PPE. which was provisional pending receipt of final valuation. These valuations were received 1st March 20x3 and resulted in an additional 3 million increase in the fair value of the PPE at the date of acquisition. This increase does not affect the fair value of NCI at acquisition. So be mindful of that. So it means that the fair value of net assets at acquisition. So it says that this valuation received on and resulted in an additional increase. So if they gave you the fair value of net asset at acquisition, which was 26, there is that thing will cause an additional increase in that, all right, by 3 million. So take note of that. PPE is to be depreciated on straight line basis. And they said any difference is because of those things. All right, so take note of that. Robbie has a 40% share joint venture. Here we are, a joint operation. Here we are again. Joint operation is different from joint venture. Joint operation, you will share the assets line by line. So if you have a PPE, you will take your share and you go and add it to your PPE. If you have revenue, you take your share, you go and add it to your revenue. So you do P&L for the joint operation and you will be taking your portion line by line, line by line. But if it is a joint venture, you will do it like as an associate. So what is your interest in the joint venture and everything? Then you will take your portion, the portion of the carrying amount of the joint venture and treat it as a one-line item, like that, the way you do associate. But for joint operation, you do P&L and balance sheet for the joint operation. And to every line, you'll be adding you will take your portion and be adding to your own. Okay, so in the joint venture, a joint operation, this is information we have. A natural gas station costs 15 million to said a natural gas station cost of 50 million to construct and was completed on 1st June 2022. It's supposed to be dismantled at the end of 10 years. The present value of the dismantling cost of the joint arrangement at 20x2 using the discount rate of 5 was 2 million. So they've done the PV for you, but there is something they've not done. Anytime a PV is done, what is left to be done, please? What is left to be done?
Unwinding.
Unwinding. Very good. So don't forget that. And the unwinding will be a current liability and it's also affecting your retained earnings. In the year, the gas with a direct cost of 60 million was sold. So that is the P&L part for 20 million. So cost to sell is 16, revenue is 20. Additionally, joint venture incurred operating costs of 0.5 million during the year. Robbie has only contributed and accounted for each share of the construction cost, paying 6 million. The revenue and costs are receivable. So listen carefully. The revenue is a receivable. The costs are payable by the other joint venture operator who settles the amount outstanding with Robbie after a year. So it means that the guy takes the monies and he will give Robbie his share. So if the revenue is the same as receivable, that is what they are trying to say. All right. So take note of that. Robbie purchased a PPE of 10 million on 20XO. So if your balance sheet here is 20x3, then it means that whatever they purchased in 20XO is already inside. It's already inside. And it has an expected useful life of 20 years and is depreciated on straight line method. On 31st May 2022, PPE was revalued. The PPE was revalued to 11 million. Then on 31st May 2023, impairment was indicators triggered an impairment review on the PPE. The recoverable amount is 7.8. The following accounting entry posted for the year to 31st May was to account for the depreciation based on revalued amounts as at 31st May 2022. The remaining Robbie accounting policy is to make transfer of excess depreciation arising from revaluation of PPE. I hope you will remember this concept. So it tells you that when they did the revaluation, the depreciation changed. And so you'll be doing a transfer of that, all right? And so it will also affect your impairment sharing. It will also affect if there is any impairment, it will also affect it. All right, take note of that. We have done this example of this question in class before, something like this before. All right. So the last one says that Robbie had a portfolio of receivable with a carrying amount of 4 million at 31st May 20X3. At that day, the entity entered into a factoring agreement with the bank whereby it transfers its receivable for 3.6 in cash. So he will sell his 4 million for a 3.6 in cash, meaning that he will lose 0.4. So he said Robbie has agreed to reimburse the factor for any shortfall between. So this is a factor with recourse. That is what it means. So it means that you have not factored it. It means any money you collect from a bank is a loan. Yeah, that is the meaning. So since you have agreed that you will reimburse the factor of any shortfall, it means when the factor goes to collect the money and he is not able to get the money, you will be paying back the money to him. So we call that kind of factoring with recourse. So I sell the debt to you. You go and collect the debt. But if you go and you are not able to collect the debt, you come back to me and collect the money you gave to me. So it means the money I took from you technically is a loan. That is it. Once the receivable has been collected, any amount above 3.6 less interest of this amount will be repaid to Robbie. Robbie has derecognized the revenues and charged 0.4 loss to the profit. Now, because it is a loan, you must bring it back to your revenue, and the loss you have charged, you must also reverse it, because the factoring that you have done is with recourse. It means when the person goes and is not able to collect the money, he is coming back to you. The 3.6 he gave it to you, he's coming to collect it back again. So it means you have not sold the thing. You haven't. So you have to reverse the transactions. Immediately prior to the year end, Robbie sold the land to a third party at a price of 60 million with an option to purchase the land back. So this is like, hey, sale and lease back kind of thing. Yeah, on July 20x13 for 60 million plus a premium of 3%. The market value of the land is 25 on 31st May, and the carrying amount was 12 million. Robbie accounted for the sale, consequently eliminating the bank overdraft at 31st May 20x3. Please, this is something we did in lease. It means that, does the transfer meet a sale? The question never told us that the transfer meets a sale. So it means there was no transfer in the first place. So the money that you collect is also a loan. The asset was never sold. So if you eliminated the asset, bring it back. All right. Prepare consolidated financial statement. So we can now see that in this question, there is two associates. You could see that there is two associates. So what you are going to do is start your balance sheet. Anywhere there was no adjustment towards the thing, you can close it. But where there are adjustments, you need to go and do your adjustment. So we know that when we pick our PPE, for example, let me use green. So let's add it. I have 30 minutes to finish this. We have 112 plus 60 plus 26. This one, we need to less the 5%, the 5, and also less the 50. The corresponding entries will be done. So this 5, that was to OCI. In our OCI, where is the OCI? So let's represent our OCI with OCE. The OCE, the parent is 11. So you do minus 5. In the same vein, this one too, you do that minus 1. And the total of 18 that you also see here, you will do, because everything must, but this one was through P&L. So it means it will affect our group workings 5. So please, when we get there, kindly remind me, so that since the names are there, they are all meant to be zeros. Remind me on that. Then financial asset, what do we have? The question never said anything about financial assets, so it means we can close that one. 6 and 14. So that will be 29, right? So that one can go straight, 29. 29. Then we have joint operation. Of course, there was something said about the joint operation, so we will wait. Current asset too, there was something said about it. So 5 plus 7 plus 12. So we will wait. Then when we get the total, we will see what we will do. All right. Stated capital, there was no share for share exchange, so that one can go straight. That is 25. So by the time they say stop work, at least you have done some entries, 25. So always check your stated capital. There may be free mark for you. With OCE, yes, we will do other adjustments if necessary. Retained earnings will come. This one will come. NCL, for now, we have 53 plus 20 plus 21. Then CL, we have 47 plus 6 plus 2. All right. So page 2 of our answer booklet, we go and do our workings. 1. The parent is Robbie. And from the question, Robbie acquired, we knew there was 2 subsidiaries. Robbie acquired Hale, 80%. The date of purchase, 1st June 20x1. And our year of reporting is May 20. So that makes it 2 years, right? 2 years. He also acquired zinc. For zinc, we realized that his acquisition, there is 5%. So he bought 5% of zinc on this date, which is 1st June 20x1, and increased it by buying additional 55%. So he will have 60% by 1st December 20x2. So from here to here is 1.5 years. So 1 year, 6 months, 1.5. Then from here to reporting date, December to May 20x3 is 6 months. So take note of that. Okay, now that we know this, we need to go and do our workings too. Fair value of net assets of SAP at acquisition, at reporting, post-acquisition. So we go to the SAP and we start. Remember, the trajectory we use is E side, then A minus any asset. All right. So let's go. The stated capital of this guy is 20. And stated capital, since it doesn't move, there is nothing. So you have here 20 stated capital, here to 20. This is it. The next thing you see, there's no OCU. Next thing is retained earnings. Retained earnings at reporting is 27. What is the retained earnings at acquisition? When you bought the 80% retained earnings at acquisition, where are you? Retained earnings at acquisition. The fair value of net identifiable was 60. Retained earnings was 16. So get the difference. That's like 11, right? So that is that. But he has given us the fair value of net assets. So we know that at the end of the day, it's supposed to be 60. And he says the difference is a fair value adjustment. But before that, always look out for this SAP that we are doing is called Hale. Is there anything Hale 2 has done? So that is where you watch out for unrealized profits. All right. Anything that they Hale, anything the subsidiary has done. Now, if you read the question well, you remember they told you that the guy has received a dividend from Hale. He has received a dividend from Hale. When we were reading, he says that he has received some dividend from Hale. Well, what was that? And I told you that we cancel the dividend. Intra-group this is it. Hale received a dividend was received from Hale. It means Hale paid a dividend. Hale paid a dividend. So the double entry, and they recorded it in the OCI. So for the parent, bring it to the retained earnings and also cancel it out. Dividend doesn't go to OCI. Dividend goes to profit. So the person who paid, for him, he paid out of his retained earnings. So when you are canceling it, you need to, so dividend. But first, let's do the fair value adjustment. So find me the difference for this. Then the dividend paid, it wasn't done on acquisition. The dividend payment was not done on acquisition. It was done at year end, and it is 2 million. You pay by reducing your retained earnings. So therefore, you will correct it by adding it back. So that is that. And so you find the difference. This is 36, then 24. The difference, therefore, fair value adjustment, land is not depreciable, so there wouldn't be anything. So here will be dash, here you have 2, and here you have 13. All right, so that is that. So 13 plus this should give you 73. That is that. Then you do the next one. Fair value of net assets of SAP at acquisition, at reporting, post-acquisition. So you start stated capital. This one, his stated capital is 10. 10. Retained earnings, you have 19. Then the retained earnings when he had control, not before control, when he had control. Where are you? Retained earnings is 15. So the difference is 4. But we were also giving fair value of net asset at acquisition. So this is it. That is the one they forgot to increase the thing by 3. So it is 26 plus the 3. So it caused the thing to increase. 26 by the 3. So you have 29. But listen carefully. They said that 29 doesn't affect the calculation of your NCI. It means that if the question tells you that they use the proportionate method, you will do the NCI percentage on the 26, not on the 29, in case they use proportionate method. That's why they always add the statement, this increase does not affect the fair value of the non-controlling interest. All right. So it means since they gave you the fair value, you won't go and add a 3 over there again. And if it were a proportionate method and they tell you that it doesn't affect it, then it means that you will still use the 26. So that is it. So what is the fair value adjustment? The fair value adjustment. They said the fair value adjustment, the difference is a PP. And how much is that? What is the difference now? This is 25, 29. That is 4. 4. So fair value adjustment depreciation. That is 4. What is the useful life? The useful life is 5 years. But this company, per the graph that we did, it is 6 months. So you do 6 over 12. All right. So 6 over 12. And that gives 0.4. So you reduce 0.4. So that means here is 3.6. That is 32.6. All right. So this is done. So immediately you will pick this one and go and add it to your PPE quickly. So that is an amount of 24. Then here too, there is this one and this one. The corresponding entry for this one is a reversal that will be in the retained earnings of the other company. All right. So here, you are going to add plus 4 minus 0.4. plus 4 minus 0.4. All right, so you've done that. So you sort that note out quickly. Then you go and do your goodwill. Goodwill. That is where the max is. Don't forget. So here you have, this one was zinc. So you have the two companies, Hale and Zinc. Purchase consideration. The purchase consideration, you saw 55 here, but you saw that they paid a cash of 50. That's what they paid. So the purchase consideration is 55 minus 5. The corresponding entry for this one, this 5 I subtracted. You also subtract it. So that is what you will do. Investment is an asset you have in somebody's account. All right. So purchase consideration is also what you are using to buy the thing. And they told you that you bought the thing, you paid 50. All of a sudden, the thing has become 55 in your balance sheet. That means it is a revaluation. All right, that is that. So you cancel it by deducting it over there and taking it out of your, they said they use fair value through OCI. And I think we have done it, right? Yeah, we've done it. We've taken it out here. So the double entry for that one is sorted. So the remaining 50 is a purchase consideration for this guy, 50. Take note of that. Then NCI. The NCI too was given. We bought it when, how much was the NCI? Non-controlling interest, 15. So you have that. Fair value of net asset at acquisition. At acquisition. So that one is 60. So you take it out. And that gives you 65 and 65 goodwill. If there is impairment, you know what to do. Purchase consideration for the other guy, he bought it by using two main methods. So fair value of previously held interest. Previous interest. Fair value of previous interest now became, how much was that? It's 5. The thing was 2. It has now become 5. So it means that there is an increase of 3. So 5 minus 2, 3. That 3 is a gain. So you must take it to your retained earnings. And that same thing added up to 18, but you had 19 there. So the 19 to the one that we have done here, minus 1, you have to also subtract it. According to the question, they use fair value through P&L. So you will take it from your retained earnings. So remind me on that when we get there. Then additional interest. Additional interest, how much did they pay? Where is the feather they bought? Okay, this is it, 16 million. As you can see, 16 million. So you have 16. NCI. The NCI is 9 here. So 9. Fair value of net assets at acquisition. We have 29. Remember, you have to correct the other one. So this one gives you what? 21,930. So here is 1. So our goodwill without any impairment we read in the question, goodwill is 6. So this is where the max is. So straight goodwill working straight 6. Then you slot it there. That is it. Then you go to your next working, which is your workings for NCI. So first do the requirement of IFRS 3. So when you finish, you look at the others. So NCI, we have NCI for Hale and Zinc. All right. So what is the NCI at acquisition for Hale? You have it here. NCI, fair value of NCI at acquisition. That is 15. This guy's own is 9. Then NCI share of post-acquisition. This NCI is 20%. So you do 20% of 13. Please, can you do that and get me the answer? And this one too, now that he bought 60, the NCI is 40% of 3.6. Oh, please, anyone, please, quick. I just have 15 minutes, please.
It says so. Hill is 2.6.
2.6.
Yeah. And
There's no
zinc
impairment. Zinc is what?
1.44.
1.44. So that is 10.44. So put it together. You also have done your NCI because there is no impairment to share. Let me punch it here. 28.04. Is that what you also had?
Yeah.
So straight 28.04. So if they say stop work, by now we have done some of the things. So then we go to where the trouble starts. Workings 5. So what is the parent retained earnings? So group retained earnings. The parent own is 70. CI share 80% of 13. Quickly, please. Then the same thing, he has 60% of 3.6.
10.4.
10.4.
2.16.
2.16. Remember, the one that I deducted from here, the one they do fair value through SPL. So that one, I need to deal with it, that particular one. So reverser, so fair value on investments. All right, so that one is 1. All right, take note of that. That is 1. All right. So when the idea here is that you have increased something that you shouldn't have increased. So you are doing it in the you did it inside, what do we call it? The first one was what do we call it? Through OCI. So you've dealt it over there. Then here to you deal with it. Fair value gain through SPL. All right. Now, there is something we also talked about, the dividend. According to the question, they had some dividends before, right? They paid dividends and they recorded it in the OCE. The OCI, sorry, which we use our OCE as a representation. That figure they put there shouldn't be there. It should come to retain earnings. Then you also write it off. So our OCE as it stands, there is a dividend of 2 there. We need to take it out. Once we take it out, we are coming to add it to the retained earnings here. So that is a dividend. But because dividend is intra-group, you have to also reverse it. So reverser. So you can just decide to take it out of the OCI or OCE and not do any recording here. But this is just to let you understand. So reversal or cancellation of intra-group dividends. That is what you see here. You have to cancel that thing. It's very, very important. So please, this one is a subtraction. So remember, I nearly left it. It's a subtraction. Like the way it shouldn't be that the thing is 18 in your books is 19. So you reverse that one too. Fair value of investments reversal. So take note of that. So you reverse it. If you also remember, what you saw is that you saw that the guy has gotten some fair value gain. If you saw that, there is a fair value gain here. You saw it here. Where is it? I did it. This is it. There is a fair value here. You must take note of that. He had a gain of 3. So that 3 must also be recorded. Anytime there is step acquisition, note that. So gain on fair value, that one is 3. So you put it there. All right. So that is that. What else have we not done up to this point? I think we've done everything up to this point, right? So we now need to go to the additional information that are from other standards here. So from C, D, E, and F, these are about separate standards. We need to deal with them. All right. Any question up to this point? Any question up to this point? All right. So let's work those standards. So we have done up to workings 5. So let's create a working 6. So working 6, we are going to deal with this one, PPE. So no, there is a joint venture. So let's do the joint venture first. Oh, it's joint operations. So please, joint operation, you do P&L for them and the balance sheet as well. So you saw that according to the question, his own is a 40% joint operation. So they are acquiring a gas station. They have a gas station. The gas station that you see is an asset. So the gas station is 15. Remember, everything that is there, chairman will take his portion of it. Everything that is there, chairman owes 40% of it. So please do 40%. Everything, the gas station. Then it has future dismantling. So present value of future dismantling. Please, I'm waiting for the 40%. Future dismantling.
6.
Is what?
6.
Okay, so that is his portion. This is about Robbie. 6. Then future dismantling is 2. The PV is 2. So do the 40% of it, everything. So the asset value is 70. 0.8. Okay. All right. So also, so this is like 6.8. That is his portion. Then we depreciate the item. What is the useful life of the thing? 10 years, right? So depreciation. This thing is happening at 1st June 20x2. So our is full year. So we will do depreciation. That is 17 over 10. That gives us 1.7. What is 40% of that? So the carrying amount of the thing is 15.3. That's the carrying amount. What is 40% of these two?
0.68.
0.68. And the difference, therefore, will be what? What's the carrying amount?
6.12.
6.12. It is a joint. So it means he shares in this one. So you will debit your PPE again. He shares in this one, a debit of PPE that you will get. All right. So that is that. So you will debit your PPE with a 6.12. Take note of that. All right. So that is what you need to note at that portion. So everything that he is doing there, he has a portion in there. You need to work it out one by one, one by one, one by one, one by one. That is how you solve a joint venture. Sorry, a joint operation. Okay, so that is that. Okay, so you take note of that. Take note of that. Okay, so you must also know that there is also a depreciation that is there. This is a depreciation that is there. This is depreciation for the current year. And so that depreciation too will be a debit. So take note of that. it is kind of going against your SPL. So we will look, let's finish it and draw what will go into, do a nice journal for all these things. Okay. So if you have the asset, this is the asset, then you have your depreciation. Let's do everything, then put a proper journal to that. Let's also do the balance sheet, the other part. It says there is a cost. There is a cost. So let's do SPL. So they get a revenue, they do a sales. So sale of the thing is 20 million. So please, the same thing, do our 40% for us. Everything you do, you'll be doing and you'll be going to add. There is also a cost to that sale. According to the question, the sale of 20 million is collected by the other person. And so the other person will pay him a year after. So the question says that the revenue and cost are revenue and receivable are the same at the same time. So do his 40%, and that 40% is also a receivable. Quickly, please. And the
8.
cost is what?
8.
8. So the 8 is also a receivable. Note that according to the question. Then the cost is 16 million. No, there's another cost here. So together the cost is 16.5. So let's add it. Cost 16.5. Oh, 16.5. So do his portion of it, 40%. Quickly.
6.6.
6.6. And the cost too is a payable. So this one is a payable. All right. So you get gross profit. What is our gross profit?
3.5.
What?
3.5.
3.5.
Wait. And 20 minus 16.5, or say,
So
isn't
gross
it that?
profit.
Uh,
Are you afraid or what?
no, but
Okay. So the depreciation that happened, let's bring the depreciation so that we won't take it to our P&L because we are doing a P&L for the depreciation. So please be doing the 40% side by side. All right. Be doing the 40% for me. So depreciation was 1.7. And here we will bring 0.68. So I want the figure here, the 40% of that. And remember, there is unwinding. Remember, anytime you do PV, there is also unwinding. And the unwinding, it will be 5% on the PV of 2 million. So quickly, please, where's my calculator so that I can help in some of
say the 3.5, we'll get 1.4 there.
1.4. All right.
Yeah.
So I want this one. 5% of 2, I think is 0.4, eh? What is 5% of 2?
5% of 2.
Yes,
That's
the
0.1.
unwinding is what?
0.1.
0.1.
Yeah.
So 0.1, what is 40% of that for this man?
0.04.
0.04. That is unwinding. Please, unwinding is going to your CL and also affecting your retained earnings. That is how it works. All right. So in total, what do you have here? What do you have here? So let's pass a nice journal for this one. Get me the total. I want this part. We just passing the journal in his book. So just give me this part. I also have an audit class very soon. I'm sure they will come in very soon. All
You
right.
say we have 1.7
For which side?
for the left.
Left, 1.7. Then 40% of that. Okay, so you
That's
did one here.
0.68.
0.68, yeah.
Yeah.
All right. So how will it pan out in our guys' books? So we know that we are debiting and PP with 6.12. And it says that the sales is also a receivable. So we will debit receivable. Once we finish, we are just going to insert it in the books. Also 0.8 million. The cost is payable. So we will go to the payable side and we will do 6.6. Then there is the depreciation. All right. Okay, we've done the depreciation and it affected this figure already. So this is a profit. So it means that we must credit our retained earnings. We have already factored in the depreciation and the net is 0.8 is a credit. We have an unwinding to do. The PV that you do, the PV in itself is a liability. Anytime you do a PV, so the PV in itself is a liability. PV, anytime you do PV. So the unwinding that you did, which is a 0. What did you say? It was 0.04. So 0.04, we will credit our, and we have already subtracted it from the retained earnings. So we are left with the unwinding. Let unwinding go to CL 0.04. So take note of that. Take note of that. And the joint venture itself. So the gas station, so the joint venture itself must also leave. So the balance that we may probably get, the joint venture, it must also leave. So take note of that. Now, apart from that, the present value of future dismantling, this one that was 2 is an NCL. It's 10 years. So NCL2 must come. His portion credits his portion of the NCL. That is what his portion will be 0.80. Any balance. So this one, any balance that is left on the account will be that thing that we are going to use to write off that joint operation that you see there.
Yeah.
So the joint operation must be written off. This is what he recorded in a share up there. So that joint operation must also be written off. So find out what is the balancing. The balancing should be the joint operation that you have, because joint operation is not an asset. You rather add the assets line by line. So I am sure that that thing they've debited in the balance sheet here, 6 here, needs to vanish. It's a joint operation. Because why? You are going to add the items to the item. So it is not a one-line item joint operation. If it was a joint venture, it would be a one-line item joint venture. By joint operation, you add each item to each item. So it can be there as joint operation. So here will be 14.12. And so we will erase the joint operation. So I'm sure the difference. What is the difference? Sharon, can you help us with that? Where is my calculator? Here you are. All right.
So I had 8.12. So you want the difference between the 14 points.
Yeah. So that should be the joint operations we must write off. It should be the 6. So you have
Yeah.
exactly.
Yeah.
So that is that. So you
Yeah.
go
So it's
and
6.
affect your balance sheet with these things. That's what you are supposed to do. So when you get to the joint operation like this, you will take away this one. So this joint operation minus 6. So that side. So never have a joint operation. If it was a joint venture, then fine. These two are gone. Then our PPE. Let me bolding this so that we can have those things to do. Our PPE, where is the journal? Oh, I won't still have it. So that we must add 6.12 to our PPE. So you come here, 6.12. 6.12. You must add that. Then what else do you have? What else? So you've done this, you've done this. Receivables, you add 8. So let's go to our receiver. That is current assets. So current assets, we must add 8. Payables, we were supposed to add 6 point something. So payables, so this is done. Payables add 6.6. So payables, current liability, 6.6. Then we had unwinding also. So 6.6 is done. So unwinding is 0.04, 0.080, then P&L 0.868. So P&L, joint venture, joint operation. That was what, 0.68, right? Then we have unwinding 0.04. Then last one, what was that? So I've done the 0.68, 0.04, NCL 0.80, his portion of the 0.80. This interesting, 0.80. So that is it for the joint venture. You've captured everything that is there. All right. Then the next standard note, the next standard is about, what is it about? D is also about a PPE they purchased. Okay. So I told you, look at the time they purchased the PPE, which means that it is already in the books. That is what has happened. It means it's already in the books. All right. So what happens is that they had something, they bought something on June 20XO. That thing is already inside. The value is 10 million. That is how much they bought it for. So you have 10 million. Now, this 10 million, you have to do your depreciation for that 10 million. So what is the depreciation for that? Accumulated depreciation up to 20x2. Accumdep. That is how many years? That's 1 year, right? Or 2 years. 20x0, yeah, that will be 2 years. So to 20x1 and 20x2. So you do 10 over useful life, 20 years, multiplied by 2. If you cancel, it is half of 2. Half of 2 is 1. That means that every year's depreciation is 0.5. That's the meaning. So note it down. Then you have 9 million. The 9 million, it was revalued. The asset was revalued. And it was revalued to 11 million. So this is the revaluation amount. So therefore, there is revaluation surplus of 2. That's the meaning. Revaluation surplus of 2. We know revaluation surplus will go to OCI. And you also add it to the asset, because the asset has been revalued. But that is not the end. This thing is still May 20x2. So we must know what is the value of access 20x3. So the question said at 20x3, they did an impairment. 20x3, they did an impairment. So we must depreciate to the end of 20x3. So depreciation. Now the asset is 11 million. What is the useful life now? You have done 2 already. So remaining useful life, 80 million. That is what it will be. 1 year. So quickly, get me the depreciation. That is 0.61. All right. So that is that. Now, so this is the depreciation. So the difference here is therefore 10.39. Now watch this. What we've been learning in class. Depreciation used to be 0.5. Now it is 0.1. What can you say? Do you remember these things we used to do in class when we were doing our PPE lessons? The examiner even gave you a clue. He says that they do a transfer of excess. They do transfer of excess to the retained earnings. Excess depreciation to retain earnings. I think my audit people have started joining. So let's finish quickly so that they can have their class in peace. All right. So excess depreciation is how much? That will be 0.11. Now, what is the treatment of excess depreciation? Treatment of excess depreciation. you will debit your OC. Now, we already know that the OCI, there is this figure going there. So you will reduce it. You will debit OCI, and you will take it to retained earnings. That is what you will do. The asset, you were told that the impairment was conducted, and the value of the asset at the end of the year is 7.8. That means that the asset impaired by how many? What's the difference? What's the impairment? And how would the impairment be treated when there is excess depreciation like this?
2.59.
2.59. So how will you do this 2.59? We did something exactly in class, and I intentionally did an exercise with you on this. So now the impairment, you see, the OCI, you had 2 there. You already had 2. And you are meant to reduce the OCI by 0.11. So the OCI balance is how much now?
No, sir, this excess will give you 1.11, not
Yes. Is it
0.1.
1.11?
Yes, please.
It's 1.11.
Yes, please. It's 0.5 plus 0.61
And
or
so
minus.
0.11 now.
Minus. Okay.
It can be
I thought we
1.1. They are
I
all
thought we're
0.0
adding.
points. You are not adding. It's excess, the
Oh,
difference.
okay, okay. Okay, sure.
So you have a balance of what? That is 1.89, right?
Yes.
So this is what is in your OCI now. And you have transferred this 0.11 to your retained earnings. So your retained earnings must be 0.11. It must go. This impairment loss, it is an impairment on a revalued asset. So the impairment, you won't carry this impairment to P&L straight. So the things we used to do, it is impairment. When you are impairing a revalued asset, you will share the impairment to clear the revaluation, because this is a revaluation loss. Revaluation loss, because this is the fair value. Revaluation loss doesn't go to P&L straight. You must offset it. So this 2.5, you will offset 1.89 in the OCI, and the balance will go to the P&L. So offset it, and let's see. Do the offsetting. How much will therefore go to your P&L? So you are spreading it. So this 2.59, you are giving the OCI how much?
0.7.
1.89. That is what you are knocking off. The remaining is what? 0.7.
7.
That will go to your P&L. So that is how you spread it. This thing simply means there is a revaluation loss. And anytime there is a revaluation loss, check if there was a revaluation surplus before, go and offset it. And that revaluation surplus, also check if I know you will remember, but probably you will not see it in the question as that thing we did. All right. You may not see it. Just a minute, please. You've done the offsetting. So technically, your OCI, you will go this figure. You go and subtract 1.89 from your OCI. And you are also subtracting this. So when we go to our OCI, you are going to subtract. We have this to subtract. Where is it? We have 0.0. So all these things were done. Oh, where is my balance sheet? Okay, so it's down here. All right. So we are deducting 0.11 first, then we are also deducting 1.89 also from it. All right. So that is it. Then in our retained earnings, also, we are supposed to go and move. We did transfer to retained earnings. So transfer to retained earnings, we are supposed to go to the retained earnings. And over there, we are going to add the transfer. So how much was the transfer? We transferred this to the retained earnings. and we also shared the impairment there. So add 0.11, then we will subtract 0.70. All right, where is our retained earnings working? So 0.11, that is excess depreciation. And we will subtract impairment, 0.70. So if the ICA is to bring this question, they can delete the joint venture. But as for something like this, they won't delete. No, because it is part of what we do here. Yeah, it is part of what we do here. So you must have it there. All right. So that is it for that part. Then you go to the last. We have this last two notes to do so that the audit people will join in. I think they are already here. So Robbie held a trade receivable. And I think I've mentioned this already, because it is a factor that they can come back and collect their money. It is without with recourse. If it was without recourse, it means that they have actually done it. That one, no problem. But since this one is factor with recourse, which means that when the factor goes to collect his money from the debtors, you sold to them, and he is not able to collect the money, he can come back. So he gave the company 3.6. The company sold their receivable to them. The bank gave the company 3.6. Now, if they go and they are not able to collect the money, they can come back. And so therefore, that 3.6 you collected, it is a loan. It is a loan. We've been discussing this a lot of times. It is a loan. So since they cancel that thing from their receivable, they derecognize it from their receivable. So it means we need to come back and recognize it. So what you will do is to debit your receivables with the 4 million back, and you record a loan. So current liability, a loan of 3.6, the money you took. Since they put the balance of 0.4 in profit, thinking that they've made a loss, and of 0.4 they put in profit, we are supposed to go back and credit our retained earnings back with a 0.4. So this is the double entry. So add 4 million to receivable, 3.6 to, so here plus 3.6. Okay, always be writing the workings number it. So receivable, we are going to add back 4, which is part of what is here. So we will add back 4. Okay. Then in our retained earnings workings, we need to add the 0.4. So reversal of loss, 0.4. All right. So that is that. Then the last one, to immediately prior to the end of the year, Robbie sold the land to a third party, 60 million, with an option to also repurchase it back. So this is like a sale and it's back. First question you need to ask yourself, did the transfer meet IFRS 15? The question never said anything like that. It didn't meet. So it means that one, to any money that you collect, is also a loan. And the asset that you write off, you have to bring it back. You have to bring it back. So take note of that. So these are how things go around it. All right. So basically, I think we are done with it. So everything has been done. So this one too, what we are going to do is it's a simple double entry. So that will mean that the asset, you need to bring it back. The carrying amount of the asset is 12 million. Now, at the end of the year, the carrying amount is 12 million. So carrying amount is what we used to do our balance sheet. And the 60 million you collected is also a loan. So the remaining 4 will go against a profit you thought you had made is 4 million. That will go against your retained earnings. So that is it. So that one too, that is that. So if this thing had been done at certain date, we would have been calculating 3% on the loan. But it looks as if this thing, everything is on 31st May. So it didn't happen in 20x2. Other than that, you'll be calculating 3%. So this one too, we need to add 12 to our PPE, 12 to our PPE. So where is our PPE? 12. We didn't bring the impairment on the impairment we shared. The impairment was on the asset, right? How much was the impairment before? Where is the impairment? The impairment that happened on the asset. The asset was already in the books. Our job was to do so the impairment together was 259. We recorded this thing in OC. We recorded this so the corresponding entry should go against the asset. That reduce the asset to this value. So we need a 2.9 to do. Then there is a 12 also to do. So plus 12 minus 2.9, 2.59, sorry, 2.59. So that is that. So we will go to our NCL. We will also add 16, the 16, NCL, 16, or CL, 16. Okay, then the difference of all retained earnings should also be done in the retained earnings. So where is our retained earnings? Retained earnings. So that one too is a reversal of a gain. So minus 4. All right, I think we have exhausted everything, right? So let's start our totals. Like I said, retained earnings is the last thing I will do in the exams. It's the last thing. So please total I think we don't need this screen side anymore. So total the asset value, the current assets, this plus this, so plus 4, 5 plus 12. Please total the asset for me. 5 plus 7 is 12, 24, 32, 36. So here is 36. Financial asset is done. This one too is done. This is done. So we just need the asset to add. This side to 11 minus 5, 6 minus 2. Wow, this one I need calculator. Where are you? Okay.
So I'm getting 241.53.
For which one?
The PPE.
2 what?
41.53.
All right. So please, somebody should also confirm 241 point.
No, let me take out this.
Oh, okay. So let me also punch this one.
So 241.13.
0.13. So use that
Yeah.
one to add everything up here for us.
Okay.
Then the NCL and the other side, somebody should also punch. So I have 11 minus 5 minus 2 minus 0.11 minus 1.89. That gives me 2 here. All right. Then this side to 53 plus 20 plus 21 plus 0.80. That is 94.8. Then 47 plus 6 plus 2 plus 6.6 plus 0.04. What is this one? Was it the 3.6? That's plus 3.6, eh? Plus 3.6 plus 16. That is 81.24. So what is the total assets? What is the total asset? We are left with the retained earnings. So give me the total asset. Let's go and add up the one. All right. Please, let's be fast now. My audit people will kill me.
Okay, so it's 312.13.
312.13. All right. So that is it. So we need to go and add up our retained earnings and income. So add the retained earnings for me, please. Let's do it. Hey, so why is this Sharon alone that is, or maybe you are the one that is at home, others are now driving or something? Let's scale it off within 2 minutes so that the audit people, once you are done, please see how people exit for me. So we have 70 plus 10.4 plus 2.16 plus, sorry, 2.16 minus 1, and these two will cancel out itself, plus 3 plus 0.68 plus 0.11 plus 0.70. Impairment is a subtraction. We have to subtract the impairment. The impairment is not an addition. What else have I done that should have been a subtraction? So it's supposed to be minus 0.70 plus 0.40 minus 4. That gives me 81.05. So confirm for me if you are done.
Confirmed.
All right.
Yes, sir, it's confirmed.
Okay. So 81.05. 81.05. So let's add everything to see. So first add the equity. All right. Add equity to get your full marks. Add equity, then add the NCI like this. Okay. Add equity side. Let me take this one off. Because asset is equal to equity plus liability. So do that. So when you finish this one, let's underline it. So that is 25 plus 2 plus 81.05 plus 28.04. So that is 136.09. So add your liabilities, then you will do another line like this if it balances. So
176.04.
it's what 176.04.
0.04.
So add these two for us. I think it is balancing because I see the 0.13.
312.13.
312.13. All right, so that is that. A lot of work goes in there, but I'm sure if you are going to, if he is bringing this question for you, if he is bringing this question for you, the note that is likely that he would delete, like you saw in last November's paper, you saw he deleted some of the notes. So the note that he is likely to delete is this one, the joint operations. Or he can decide to delete these two and leave the joint operation, because the joint operation looks as if there is always work in that area. And it is part of your syllabus. All right. So it's exactly 6:30. I'm ending it here. The audit people, you can